So Kharis Capital is a 3-year-old private equity firm that wants to be different in this very crowded world of private equity funds, in the sense that we are not structured as a fund, but we are structured as a deal-by-deal firm that invests directly into companies with the backing of families in the consumer sector, with the predominance of Europe in mid-cap companies. So we now did 4 investments in the last 3 years. That means as well that when we invest, we don't spread ourselves thin. We focus on specific segments that we identify as being interesting and attractive in the long run. And the biggest investments we made are in the fast food sector right now. So we have 3 brands in 5 countries with a total of 500 restaurants, with Burger King, Quick, and Otakos. And the countries covered are Belgium, Luxembourg, Italy, Poland, and France. The ultimate objective of Kharis is to build 3 or 4 such pillars in different sectors like healthcare, luxury, healthy food as well, or innovative food. And the difference to fund beside this, deal-by-deal structure is also that the families who invest with us in these companies get certain voting rights on strategic matters like exit, so that we basically form a partnership with them more than an LP-GP traditional relationship. We also recently launched a RIFE, so it's more of a co-investment vehicle to allow smaller investors or big investors who want to put smaller tickets with us, with which they will then get exposed to the next 3 deals over a period of 2.5 years. But the whole philosophy when it comes to the economic model is Kharis doesn't believe that investors should be charged on committed capital, but only on money that is actually working. So whatever happens, whether direct or via the RIFE, investors only pay us a management fee to run the investment once the money is invested. And that's what I like about it, because I've been in the sector for 16 years, and I think it brings the best of private equity funds being professional and diligent when they look at an investment, but the family ownership, which means that you are more long-term, more focused, and also more aligned. I mean, there's a big toolbox at the disposal of private equity investors, but our overarching principle is that we are growth investors. So we like to drive growth, top line, whether it's by internationalizing the business or by introducing new products. And that's very important for us. That's why we have this multi-country platform in the fast food sector. And within this, then that means that to enable the growth, you have to strengthen the management team that we feel a partner of. You can as well improve the processes within the company. In the case of the latest investment we made, it's a very fast-growing, very innovative business. We hopefully will be able to bring them more structure in the way they do sourcing, they do customer relationship, and the way they also select their partners, because it's a franchise-based model of restaurants. So professionalizing businesses allows to boost growth. And in that sense, as much as, of course, we also think we can streamline costs, we don't focus as much on cost cutting as we do on top line growth. And usually a company that trusts us is because we really bring them a professional way to internationalize and also leverage the digital potential. That's the 2 pillars of our brands that we are very focused on when it comes to create value. I think it depends on the role you have, so I'm not going to speak only for Kharis. If you're a minority investor, you probably bring capital, and then you have to piggyback on whatever is happening on the majority side, so your potential to actually influence the company is more limited. If you are an actively involved investor and either have veto rights or a majority and therefore control, you can more easily influence it. But I think without a good partnership and spirit and alignment of interest and governance structure with the manager and all the stakeholders, it's difficult to unleash that potential. I think the other thing we sometimes underestimate is when you actually do a merger with another company, the cultural differences in the way people work can impede the value creation process. And finally, I think time is an important factor. If you try to speed things up too fast, if you try to cut corners, then probably you jeopardize your value creation potential. So in our case, if I come back to Kharis, our holding periods are open-ended, although our investment cases are built that the value creation will be optimal after 5 years. We reserve the right with our families to stay longer or to do something earlier. So flexibility is key as well. Time, first of all, because you were in the panel. I think we never jump into a business and think that within 3 months we can own it and be good at building value. I think you build trust, like in any relationship. As humans, you need to get to know the people. It's also looking in the same direction. So let's say if we back an entrepreneur who we know wants to stay another 5 years and maybe consider his future, it's maybe better than someone also who wants to control everything and not get any outside input. So alignment of interest again, that we all have skin in the game, I think will be important. So our teams know that we invest personally in every deal, and therefore the trust is built both on the human side but also on the financial side. And then things that you cannot completely control is this whole chemistry element that is important, but usually you see this quite early in the relationship. And after that, I think we're good at empowering our managers, so we don't substitute ourselves to them. We let them run the business day to day with very close involvement. So the Kharis team will sit on the board of the company and on the executive committee of the company, but we have clear roles as to who does what, and we don't step onto their toes when it comes to things that they believe they should run by themselves, but everything is validated together. Yeah, as I said, we've selected investments based on 3 pillars. The first one is the potential of the brand to be strong, the potential of the brand, the company to grow internationally, and the third one is digitization. It's an overarching as well element. It's a bit of a buzzword in certain cases because people think of e-commerce and selling online, but today digital runs through the whole business model of businesses. We happen to have members in the team who have done a lot of digital investments, and for us we look at the sourcing, we look at customer relationship, we look at, of course, front end, so e-commerce as well, and we believe that today if you don't jump into this bandwagon, you will be very soon lost. So whether it's on Burger King or Quick or Otakos, our latest investment, it's embedded in our action plan.